This is a quick video update on Bitcoin. We're still tracking in the redistribution range between what has been effectively 18,000 to 22.7K. Um, Obviously, this chart is inverted, so they brought it. I'll just I'll change it around to be able to speak accurately about what the moves were. So obviously, we were tracking the last couple of weeks this range that was being formed. Maybe it'll be better shown on the measured chart. This range that was being formed where we take it from the origin of the final capitulation into the low. We form a narrow trading range, and then we insert some other levels based on volume and volatility at certain points. We see that they were elevating the price in the kind of the higher parts of the range. Uh, we predicted they were going to run the stops because they were buying here, they were buying here. We predicted they were going to run the stops of retail traders who were long the market with them here. The market maker has the privilege of being able to buy when he knows price is going down. Us, as not so much retail traders, but from his perspective, still opponents to his trades, we don't have that luxury because we don't know exactly where price is going to go. So, as discussed in the previous video, the market maker was able to con retail liquidity to short the market into the bottom of the range and was able to steal all their money, um, and then use their short stop losses to kind of add liquidity to this range. If we go back to this chart, we can see that the market maker brought price right down into this liquidity area where he knew he could trap retail into thinking it was going lower. Um, so taking their coins that they sold to him off them before realizing a profit on the manipulation. Now, granted, we didn't quite go as high as I anticipated. It doesn't mean it's not precluded to do so. Um, we have come back to this kind of final capitulation, and just like we have origins of final capitulations in these areas, it happens on all time frames, on all structures. So this is a capitulation area to the upside. You see we've fully retraced that into the medium term mean on the 4-hour time frame, into the volume cluster, indicating that there is liquidity there to be tapped and is likely being tapped at this point. So it's not precluded that price does eventually go into that area by making a, well, what would be a higher high in the structure, um, but that remains to be seen. The point is we are in a we're in a compressionary period, um, which has been discussed and which is necessary to allow price to easily move in the direction the market makers want. So we are getting closer to what I perceive to be a breakdown, um, and it's just a case of how the market, and this is easier to kind of view in the inverted chart, which is why I kind of have this chart inverted, is because you can see the setup, you can see what they're doing here very clearly coming back to the bottom of the range, and I think that there is money there for them to take. Doesn't mean they have to take it. They could get it on the way back up. They could send this market to 10K, knowing that that liquidity is always there for them. So it's just a case of how much of a short position or how light of a spot long position they want to have before they move the market lower, which would obviously be up on this chart because it's inverted. So it's really a case of monitoring the markets over the coming days to see how price action is going to behave in essentially this area, um, because it's what they do here, which is what we need to be paying attention for. And that's why I was kind of keen to point out that, all of this was likely to be noise. It's important noise because it shows you what they're doing. And whilst they're not moving price up and down in a material way, like in this trend, what they do here is still important. And the fact that they were respecting the range both on just a price action basis, like by respecting the levels as highlighted in this chart, like it's not a coincidence this vector candle that was all the way up here at one point was pushed back down for the close. That's where they came back for retail liquidity. So the fact that they're respecting these boundaries within this consolidation phase shows how orderly the market is. And when you have an orderly market in an accumulation or a distribution phase, you can have a lot more confidence in your idea when price gets to the breakout point. And that is what this chart is signifying, that we are indeed getting toward the breakout point. Um, Price is compressing into into itself. All these data sets on a long and short-term basis are compressing. This is not a directional indicator. This indicates data set compression. So when the indicator is going up, the data set is expanding relative to the time frame being inputted here. So this is a downtrend. Obviously, the chart's inverted. So this expanding data set was indicating that price was expanding. It doesn't tell you direction. So when we get compression, which is this oscillator going down, and obviously shorter term time frames will compress and expand at a quicker rate than longer term time frames. And by time frames in this instance, I don't mean the time frame as in the time frame being looked at. I really mean look back period of the data set. So whatever amount of candles you want to put into the data set. And obviously this part is proprietary and it's not something I'm going to share, but suffice it to say we are compressing, and you see that when you get these sort of expansive crossovers, which we're about to get, it indicates times in the market when you might want to pay attention and try and get a position. One might want to try and get a position with the perceived trend or wherever the trend is. And as we know, the trend is presumably down. This is the first push with consolidation, second push consolidation, and we're expecting um, when a few more checkboxes are ticked to get an expansive move on the daily and 4-hour time frames to kind of go along with the fact that we are already very clearly trending down on the weekly time frame. I'm going to make that point even clearer now. Just tidying up this chart a wee bit, getting rid of the inversion. You can see instances. So I quickly just pause the video there to make some amendments to settings without having to give away proprietary information. So we see that this data set, which is the shorter term data set on the weekly time frame, we can see that when it is expanding, which is indicated by, obviously, anyone experienced with the system can just see that it's expanding with price outside the data set and being kind of supported by the data set, but it's also confirmed by this expanding oscillator value, indicating that the data set is growing in size. Same here, blue to blue. Same here, blue to blue. So that is to say, we look for periods in these markets where trending is in operation, because what you want to do is you want to have a trend that's occurring on a larger time frame, i.e., in this case, the weekly time frame, and you want to be able to treat that as essentially train tracks towards a destination. And then on these lower time frames, you're narrowing in points at which you can kind of get on for a low risk, high reward, high probability entry with this prevailing trend. So just like here, and we know the market makers like to move things in three. That's just an observable fact. So you have one push, two push, three push. Here you have one push, two push, three push, all the time being supported by this data set. And when price broke within the data set, it indicated that the trend was finished and that sideways consolidation was going to happen. And it happened here as well. And if we go to the present, we invert just for ease of viewing, we can see that we have a volatility expansion outside this data set. We have one push, we have a supporting uh, the data set acting as support. We have another push. We have the data set acting as support, and what I feel is going to be a third push down into wherever. Obviously, we have targets, but it's a case of observing the price action at the time and taking volatility signals that would indicate to us that the trend is over. So, for example, we have this data set here. If price was to trickle within it um, and begin consolidating sideways on a weekly basis, it would indicate that this move is likely done. It doesn't mean the low is in, but it means that this trend, which is supporting further movement along the train tracks towards the low, is no longer in operation at this time. Um, so that's why we use this system in conjunction with a number of other systems to try and indicate to us when the time is best to get on the train, so to speak. So we know in a weekly time frame we are coming into the area at which price either has to kind of do or die. It's Like price can do whatever the hell it wants. So we've just coded these algorithmic data sets to kind of pinpoint high likelihood points in the chart when the market makers are going to continue their operations. So you see we have in the previous one, which is almost identical to the current one, we had two pushes into that external band of the data set. We've already had one. We're likely going to get a second one this week, which kind of coincides with that structure that was being shown. And this longer term data set in the 4-hour time frame is suggesting kind of this is a period where we'll get that second push before a continued move down. So we're using this independent structure. We're using this weekly structure to kind of set the tone. And then we're using this one to indicate when kind of short-term expectations are going to match with long-term expectations. Because this is short-term expectations. This is a 4-hour consolidation that has been going on for almost a month. This is long-term expectations of the market. So this is, you see there's quite a lot of data here, but this is the longer term expectations of this market. Um, so the idea is we're looking for continuation of the trend because the trend will persist until it no longer persists. And we have a statistically evidenced way of showing when the trend is no longer in effect. Like you see the price was being supported the whole way up here by this outer band. All it got was wicks within, supported the whole way, and then it started to lose momentum. We got a stop hunt above the data set, bring it back in, retest it from the underside, and then price went straight to the other side of the data set. Same here, it was able to be quantified at the fake out stop hunt at the November 2021 fake all-time high, which was when they took out the stops of the April 65K high and brought it back within the range, even on a non-volatility basis, back below this candle, but also back within the data set before kind of moving it to the bottom range, starting to consolidate, hitting the short-term mean, and then beginning the downtrend that has been in effect since, technically been in effect since the 2nd of May, but was kind of foretold and expected on the basis of known market maker operations since about this consolidation period. Same here. So it's just about seeing things that they've done in the past, quantifying them, and looking for when they happen again in the future, and then being able to use market maker psychology, the way in which they try to trap retail, but also kind of pairing that with a quantified, objective viewpoint as to where price is. So we will not be looking, or we will not be entertaining the idea that the market has bottomed, or that the low may be in, and that we're going into a more macro consolidation until price closes within this data set. So that is to say, there's no rule that says price can't wick within, but just like you see here, price gets heavily constrained by this downward expanding data set, and these wicks are kind of proof of that. So by that logic, we may not take out last week's high, but we may run for the liquidity above, which is around 23.3K. But this is doesn't have to necessarily be an extreme point of price. So we don't use these for precise price signals. It's more just like what is price doing in relation to the data sets, and what can that tell us about the characteristics of price currently, i.e., is it in a consolidation or is it in a trend? And this applies to all data sets on all time frames. This is the weekly short term, but the same logic applies to the 4-hour longer term data set, which we see we're back within. So once price got within there, that was then the condition of the market on the 4-hour time frame from the perspective of this data set, which we see is a very important one because price likes to follow this data set. If we go back in time, this is uh, this is how they quantify the consolidation periods of their trends. If we go back to the bull market operation in 2019, we'll see the same thing. We'll see that this data set, just going to pause the video again and get rid of some of the parameters without giving away the actual variables of the indicator. So we see that just like in the present day, when price gets back in the data set, it starts to compress, and then price has a very difficult time continuing the trend. Obviously, they ran stops above here, and that's why I was very clear in previous videos to say that a break of the high or the low in question in the data set, even if it kind of fakes out of the data set, is not necessarily It doesn't necessarily invalidate the idea because it's something that they absolutely can do. Now, granted, in the current market, it's been much more orderly. That they haven't really run the low. Once they got back in the data set, they sort of wicked a little bit below. Here in this one, we got this move outside, which was followed by that massive move, which we've explained on another basis was the running of the lows and the taking out of the short stops of the retail shorts that were committed here, thinking it was going to the bottom of the range before they moved it up into the previous vector zones, taking out these stops. So if you imagine this little area here is basically retail stops because they've trapped them into thinking that the range is narrower than it actually is. So if you take this low and this high, you'll see that that's not very clear. You'll see that the stops are getting run both ways because they're trapping retail longs here and taking out their stops, and they're trapping retail shorts in the market in this area and then taking out their stops in just the same way. So it's almost a mirror image pattern of what they did here is what they're doing again. So they may have run the liquidity already. They may not need the liquidity here. That's why it's a probabilities game, and you need to have multiple interplaying systems telling you kind of the likely position of price, and the likely trajectory of price on as it relates to kind of multiple aspects of a system. So they may have run the low. They may have, well, what is low in this chart, but it's obviously highs because the chart's inverted. But they may have captured all the liquidity that they need here, um, to justify moving it down further. Or so they may just retest the zone before moving it, or they may want to run the liquidity here just like they did in the previous range and push it below this high because they have a lot of people potentially on the market now short who think they're the best trader in the world, and they know there's stops above this high because obviously there is. So it wouldn't surprise me to see them run the high. So really, you wouldn't want to be having stop losses here because it's so obvious. It's so obvious, and there's nothing really more frustrating than being right and being stopped out because your stop loss was too obvious. So if you're going to enter the market anywhere, it would be, and obviously not financial advice. This is a diary entry to myself that just happens to be shared with other people. So I'm speaking to myself when I give these sorts of advices in these videos. But as and it's likely price will trickle back down towards the long-term mean on the 4-hour time frame, pairing with a retest into the weekly macro data set. Um, as price gets to this area, you could open shorts expecting the trend to go in the same direction as it's been going because we're only in this is the second of three moves as I've previously explained. But you can't have a stop loss here. You just can't because you're asking to be stopped out. Like it's very possible that they do a lower high, bottom of the market here, and higher highs, lower highs, all that sort of stuff is relevant in a very narrow window of price. Just like they fake people out with downward parabolas all the time. People shorting the market here get ruined when they're actually correct. They were just early. Um, it's fine to look for structure when actually the market maker is looking to do the same thing as what your structure suggests. So at this point, the market will have compressed enough that a higher low or a lower high because the chart's inverted is fine to look for. Whereas in these aspects, they're used as traps. Like this big volume push, oh, that's a higher low, that's a lower high, depending on what way you look at the chart. It's like, no, it isn't, because they're still in the consolidation phase and they're still running liquidity. Whereas here is when price will calm down and you can actually take a trade there um, comfortably. But what you cannot do is put a stop loss under this obvious point, or which would be above because the chart's inverted. I'm just going to make the chart the normal way around to stop having to uh, caveat what I'm saying. But you can't have a stop loss here because they could easily run the liquidity easily. Like you could get a situation where price is trickling up, topping structure, bang, right through the stops, and then continues. You can't have a stop loss there. You need to assume that they will take the liquidity there and factor that into your trading ideas, unless you want to have a system where you are taking multiple tries at the same idea. So you could have a system where you are shorting the market here, putting a stop here, expecting that they could run the liquidity. So let's say you're getting 10 to 1 here with a stop loss there. If you have your stop loss up here, maybe you're only getting 5 to 1. So you're giving yourself two shots at a 10 to 1 rather than one shot at a 5 to 1, which is essentially over a long-term law of large numbers perception of how probabilities work is essentially the same trade. Like two goes at a 10 to 1 is the same as one go at a 5 to 1 if the probability of the 5 to 1 is double what you're getting with the 10 to 1. So you can't have a stop there. It's too obvious. Um, so if you're going to enter into the market here in between these vector zones, assuming that they're going to have an orderly market, knowing that they've taken the money here, an orderly market similar to how they did it in the last point, the last move down was where this is the similar point of where we are basically now. So they brought the market back up nice and orderly simply into this capitulation area. But had you had a stop loss there, yeah, you would have worked out. It would have worked out okay on this occasion. But you were asking to be run. You were asking for your stop loss to be run, and they knew your stop loss was there. And in my opinion, you basically got lucky not being hunted. So the idea is you're going to look for a short in this range, and you're going to want to treat all of this area as entry points. The idea you would have a stop loss here is you're saying to the market, if price goes to this point, my idea of downward continuation is wrong. So therefore, it's flawed to have a stop loss there because they can easily run it within the universe of your idea still being correct. So you need to be looking at this area in its totality as a place to enter short with a stop loss somewhere above the high, well above the high. Um, and that's up to your own risk parameters based on what targets you see based on your own strategy. But the stop loss has to be here. The stop loss cannot be here because they can easily run the liquidity, and it's something they do all the time. Like people with stop losses here, for example, I'll just put my stop loss at the high. No, sorry, that's not going to happen. They do it all the time on all time frames, and you need to be aware that this is a move that they have because if they need a short position big enough, they will run your stop no problem. So you can't have it at obvious points. Simple as that. Just like the stops here are obvious, done. Stops here are obvious, done. If your stop is here and obvious, you might not get done because they might have the liquidity that they need to justify the move down. So we could be getting, as discussed in the previous video, the beginning of a downward parabola here with this being a lower high, but they could easily run the money here. So the way I think about the market is I don't have a stop loss there. Uh, I have an order to add to my position here because I want to take advantage of the fact that they could run the stops, and I want to take that liquidity off people who do not know that this is an obvious and stupid point to put a stop loss. So if I'm going to be adding to if I'm going to be opening a short position here, I'm not going to have the market take my position away from me here. I'm going to have it add to my position here and have the stop loss further above because the further above they get, and especially if we get this data set coming down to cap price, like this is a gorgeous place to have a stop loss because you have both enough of a distance on a time base or on a price basis between the obvious point that they can run for the money and where your stop loss is. But also you have a downward compressing data set kind of capping the ability, just like it was capping the ability here. Like it doesn't make it impossible, which is why you still need to have a bit of distance between the data set and your stop. But it makes it less likely that they're going to push up through, especially when their macro intention is now down and they're getting closer to the breakout point. Like this was the middle of the consolidation. That's why they can kind of mess around in the range. So that's my update for now. Tracking very nicely in the measurement range that has been drawn since about, I don't know, mid-June. Um, Respecting the levels very nicely, behaving exactly as expected, both on a price action basis, a volume basis, and a volatility basis. And it's just about waiting now for the compression to complete before the what I believe is going to be the third leg down into whatever the low is. We'll have to examine structure and we'll examine how price is behaving in the data set. We're probably not going to catch the exact low, like just like you didn't catch the exact high here, you were tipped off to the fact that the trend was over by the retest. So I don't need to take the low if I can get 30% off the low with data set confirmation that I am actually right in assuming the market has bottomed. Uh, just like here, this trend was over signified by a move back within the data set. Like, yeah, maybe you didn't catch the 13,880 high, but if you could get out at, 11.3K after getting in at three and a half, that's not bad. And you don't need to catch the extreme moves. And in fact, the probability of being correct is higher if you wait for confirmation on a data set basis. So, do you want 50% probability of a 100% move, or do you want an 80% probability of a 60% move? And I'll let you work out the maths on that, but that's how you do it. So, we'll be looking for these sort of signals, price coming back inside the macro data sets, indicating that the trend that was in operation here and here and here and here is over. And that's what we'll be looking for. As for timing, my timing window is as drawn. I never call exact timing, but within the next week, I think we should have that final structure put in and the market begin to move down towards the breakout of this data set, just like here. And we would hopefully see then continuation down into whatever that target is going to be. It's a wide range. It's a very wide range, but we'll examine the price action at the time. But that's what I'm seeing. That's what I've been seeing for months. That's what in this specific example. That's what I've been seeing for the last month. A similar trading range to the one that went before it. I see no reason to deviate from that idea at this time. We'll continue to monitor the markets, update Twitter with whatever is relevant. Um, and yeah, just continue to hope that this edge persists because the market is behaving exactly as our system likes the market to behave. And this is not always the case. You don't always get these moments where multiple systems are interplaying with each other in such a beautiful way. But this is one of these times, and we have to be grateful and try to capitalize as best we can on these opportunities as they arise.